Welcome to the May Economic Outlook Report. My name is Natalie Gallagher, and I am the Principal Economist and Director of Economic Research here at Board. I'm going to spend some time today walking through the most realistic trajectory for the U.S. economy in a post-tariff environment, which, as we're going to discuss in detail, is anticipated to be marked by below-trend real GDP growth, accelerating inflation, and unfortunately, a weakening labor market. Now, to really set the stage for where GDP growth or economic growth is anticipated to head in 2025, I want to compare against where it was anticipated to land back in early January. And so you can see here that the landscape has drastically shifted over the last several months. Back in early January, we were having conversations around to what degree the economy was anticipated to outperform. Now, of course, the conversation has shifted to what degree it's anticipated to underperform. Now, this sharp downgrade really sets the stage for a much more vulnerable economy as we make our way through 2025, one that's much more susceptible to shocks. Driving the initial positive estimate or more positive, higher estimate was steady, resilient consumer spending bolstered by real income gains. We also saw a lot of evidence of further business investment. Now, of course, we're in a much different picture when it comes to both of these factors. Now, highlighting one of the main reasons, the impact from tariff-induced price pressures is really a higher overall inflation rate, a reacceleration in the inflation rate. And this comes down to the fact that as producers experience higher input costs, they're very likely to pass those on to the end consumer, which is, of course, where we get sort of this reacceleration in inflation. You can see here that we did anticipate inflation to come down over the year. It was anticipated to be a bit sticky, but really decelerate back down to that 2% Fed target, probably getting there around early 2026. Now we're sort of in a realm where we don't anticipate inflation to disinflate. We actually anticipate it to reaccelerate about mid-year. So question I get quite often is, when is this actually going to hit the hard data? Down to some fundamentals, it is anticipated to hit the data closer to May, June, July timeframe. Now, this is anticipated to filter through to consumers in not only higher prices that they're paying at the store, but it also hits home to their purchasing power. So when we look at real disposable personal income, which is income, and then we inflation adjust it to get it in real terms, we see that before tariffs, real income was expected to grow at 1.7%. Now, this is a pretty healthy cadence to support resilient consumer spending. Now we've sort of downgraded that estimate following that increase in inflation down to 0.9%. Now, this is a pretty low growth rate. So if we take out 2022 from the equation, it's actually the lowest growth rate since 2013. And it's not that consumers are going to see their paycheck shrink, but when they go to the store and buy volume quantity, there's a drag there on how much they can actually afford. So their real purchasing power sort of hit hardest in this regard. Now, at the same time, unfortunately, so we've really honed in on two legs of the stagflation stool, if you will. We've hit on lower economic growth as well as accelerating prices. Sort of the third, the trifecta to bring it all together, is a rising unemployment rate, which we do see on the horizon. So over the last several quarters, inflation has sort of plateaued off about 4 to 4.2%. We do anticipate it's going to rise up to 4.5% in around Q3 and then sort of hold there in Q4. And while this isn't a catastrophic rise in the unemployment rate, it does sort of speak to the labor conditions that individual job seekers are really facing. So, in survey reports, in sentiment variables, we really see that consumers are coming out and they're saying, we're having a really hard time finding work. So even though the unemployment rate might look low in a historical sense, it's actually a really competitive environment. And this is actually affirmed when we look at things like the continued claims data or the average week unemployed. Now, this is anticipated to continue and even get a little bit more difficult for job seekers as we make our way through the year. And businesses are sort of put in this position where they have to be quite cautious and quite intentional with the decisions that they make on the cost side of their balance sheet. Now, when we zoom out, there's sort of a pattern of economic pressure that becomes really prevalent and really concerning. And so in the last 5 years, we've really we're on our third sort of economic pressure point. First came COVID, which was a true black swan event that no one could have predicted or controlled for. But of course, it's still a psychological strain on households, on individuals as the pandemic sort of takes hold. Second, you have 2022, where consumers are grappling with the highest inflation since the 1980s, aggressive monetary tightening, and also supply side constraints. That's a difficult time as well. And this time around, it's policy driven, with tariffs fueling price increases and also just general economic uncertainty, causing quite a bit of heartburn, not only for households, but also for businesses, really just everyone involved. And what's critical here is actually the compounding effect. So consumers haven't really had time to psychologically recover, right, from the pandemic, and then 2022, and then inflation is coming under control. There's, extreme inflation fatigue. Now they're sort of getting hurled into the next saga, if you will, of economic volatility, which is a trade war and tariff price pressures. Now, this is sort of resulting in consumers approaching the economy not as sort of a stable entity that chugs along, but much more something that is quite volatile, shifts quite frequently, and it really changes the mindset of the consumer into a more defensive positioning than we may be in when we were in, say, the Great Expansionary Period after the '08 recession recovery. And we really see this showcased in the consumer sentiment numbers. So a lot of preemptive pessimism in the consumer sentiment numbers. Since December, we've already seen sentiment plummet sort of 30%. And this is before the full impact of tariff-driven inflation and real income erosion has even hit the data or, really hit consumers where they're at, which is anticipated to occur in about May, June, July. Now, as we sort of set the stage for where consumers are at and the general economy at large, we're in a very sort of insecure, vulnerable position. We have sluggish growth on the horizon, rising inflation, reaccelerating inflation, falling real income levels because of those factors, and also a softening labor market and extreme consumer pessimism. And in that environment, it creates quite a hurdle for the Federal Reserve because they're walking a really, really thin tightrope. And, unfortunately for the Federal Reserve, maybe sort of been on this thin tightrope since 2020. And even though the market is pricing in multiple rate cuts for 2025, expecting the Fed to respond to, elevated unemployment or a moderately rising unemployment rate and softening growth, our outlook is that Fed is very likely to actually hold rates steady. And that's because core inflation is not only anticipated to be elevated, it's anticipated to reaccelerate. So this puts policymakers in a historically familiar, albeit dangerous position where if they cut too soon, they risk inflation sort of running away from them. And because of this, and the risk of sort of repeating some 1970s monetary policy errors, you really see the most realistic path forward, the Federal Reserve holding rates constant and really accepting slower growth, a moderately rising unemployment rate in order to get price stability under control. Now, of course, this has the negative effect on households and businesses of, not offering reprieve to borrowing costs and things of that nature. But at the same time, the hope is that you get inflation under control and don't have a much worse monetary policy crisis on your hands. Now, all of that to say, the economic picture is one with many pressure points as we sort of get into the middle of 2025. We have a challenging mix of macroeconomic pressures among slower economic growth, rising inflation, a softening labor market, and also consumer pessimism that's quite prevalent through the economy. Now, in this environment, the difficulty is exacerbated by the fact that households, consumers, businesses, they're all being asked to make decisions in an environment that is really defined by volatility, which can be quite tricky to get right. Now, as an economist, it's always my suggestion to focus on external indicators wherever you can in your business planning, also integrate the most realistic path forward for the economic trajectory, and being very adaptable to how this might change as we make our way through 2025. I'm also a huge proponent of scenario planning, what if analysis, so that should things change, which is very likely that the economy will continue to be quite volatile as we get through this year, there's sort of a playbook and a path forward so that you're not starting from zero, but you have a little bit of a head start. Now, we do offer our own solutions for these problems here at Board, and if you would like to learn more about them, go to board.com and request a demo. With that, I just want to say thank you for your time. It's been a privilege, and I look forward to seeing you again next month.